this is Amit Pabari, founder and managing director of CR Forex. Over the weekend, we have heard the news of Israel war. Now, let us understand what impact it will have on markets and different asset classes. So, let me start with oil. It is a negative news for oil, and oil price can go higher. Then comes gold and dollar index. Both generally moves higher whenever there is a geopolitical tension arises, because people move towards safer assets, and for equity it will be a negative as people try to take money out of riskier asset and they put in safe haven assets like gold or dollar. In October 1973, similar war-like situation happened in Israel, because of which oil price had shoot up by 70%. Now the question is whether it is a repeat of 1973. The key difference between 1973 and 2023 is, at that point of time, 6 to 7 Arab countries combinedly attacked Israel, and this time it is only between Israel and Palestine. If other countries join the war from both the sides, then a local war between Israel and Palestine can turn into a global geopolitical tension, and which can make markets ugly for next few days. Now let us discuss outlook for rupee. When market was closed on Friday, it was hinting that rupee might appreciate from 83.30 levels towards 82.80 kind of a level because of two reasons. Crude oil price have fallen more than 10% in last 6 to 7 trading session, and dollar index also shown sign of reversal. But on weekend, we have got the news of Israel war that has started creating bit of tension over the market, because of which oil prices can go higher, dollar index can move higher, and it can create pressure on all emerging market currencies. But as far as rupee is concerned, we expect RBI to intervene on Monday morning and prevent the sharp depreciation of rupee, and hence the pair can consolidate between 80 to 90 to 83.40 kind of levels. Now let us discuss strategy for thick margin exporter. If the pair is trading in a consolidation manner between 83 to 83.30 kind of a level, in that case thick margin exporter should follow the same strategy what we have been discussing from last 2 weeks, that on a confirm order basis you hedge 80 to 85% of the exposure. If you are hedging on anticipation basis, you hedge 55 to 60% of annual turnover. And in case if the pair breaks 83.45 kind of level, because geopolitical tension gets escalated and RBI do not intervene aggressively, and in that case exporter should wait to cover at high levels of 83.75 and 83.90 kind of a level. There is an important note: at CR Forex we believe that there is a higher probability that the pair might continue to trade in a consolidating manner between 80 to 90 on the lower side and 83.40 on the higher side. Now let us discuss strategy for thin margin exporters like agri exporter or chemical exporters. A lot of thin margin exporters have taken costing between 83 to 83.15 kind of a level. Now a lot of thin margin exporters will have a temptation whether they can get 83.50 or 84 kind of levels or not. In such a volatile kind of situation, thin margin exporters should do following kind of strategy. Strategy number 1 is they can hedge via option. If they hedge via option, they can get an upside while they can protect their costing. To get further guidance, they can connect with my team. If someone is hedging via forward, then they should do a following kind of strategy. Hedge 50 to 70% of the exposure between 83.20 to 83.30 kind of a level, because we have observed that RBI has been protecting 83.30 from quite some time, and it might not allow a sharp depreciation. So at that point of time, it is advisable that you cover 50 to 70% of the exposure. For remaining exposure, you should keep a strict stop loss of 83 or costing whichever is higher. Now let us discuss strategy for importers. Generally, the pace of depreciation is more than the pace of appreciation, because as a country we are net importers, and at any point of time, whenever any geopolitical tension arises, rupee gets weaker. So ideal strategy for any importer is that they should immediately go and cover their exposure. But the question is how much they should cover. we will suggest importers that they should cover 60 to 70% of their import payable for next 30 days between 83 to 83.10 kind of a level. For remaining exposure, they should keep a strict stop loss of 83.45. If 83.45 is broken, then they should immediately cover 100% of their imports payable within next 30 days. With this, I will end my today's presentation. Jai Hind, Namaskar, फिर मिलेंगे next week. Thank you.